Good morning, everybody, and thank you for tuning in to this Centre for Policy Studies webinar. My name's Eamonn Ives, and I'll be chairing today's proceedings. Today's event is the final instalment in our Getting to Net Zero series, which we've been running to coincide around COP26. We began the series all the way back at Conservative Party conference and have covered a diverse range of different issues, all to do with decarbonising the UK economy in line with its ambition to reach net zero by 2050. In our discussion today, we'll be considering how the financial services sector in the UK can help in terms of hastening that decarbonisation. And I'm delighted to be joined by another excellent panel to explore that question. Before introducing my panellists, however, I'll just run through how the next hour or so will unfold. So we'll start things off with introductory remarks from each of our panellists before moving on to a short discussion amongst ourselves, picking up on some of what we've just heard. After that, we'll then take questions from the audience, but you don't need to wait until then to get a question in. If you have one, please use the Q&A function whenever you wish. And then finally, just before we wrap up, I'll hand over to Frank Carson from Aviva for some quick words. Aviva have been our partner organisation throughout this whole series, and we're extremely grateful for their support and also for contributing some fantastic speakers who've been able to give a really good perspective on the issues we've covered. Anyway, without any further ado, I'm delighted to bring in each of our panellists. So we will kick off with remarks from Thomas Tayler, who's the Senior Manager of Aviva's Investors Sustainable Finance Centre for Excellence. Aviva has an ambition to be net zero emissions asset manager by 2050, not by 2050, but by 2040, in fact. So I'm particularly interested to get his thoughts on how Aviva plans to get there, and of course his wider thoughts on the question of net zero and generally, and what failure to meet it spells for the financial services sector. So Thomas, if you'd like to give us your remarks.
Thank you, Eamonn. Thank you very much for the invitation to join you. And I look forward to hearing what fellow panelists have to say. I think it's important to start in terms of your big question. I mean, financial services is absolutely crucial to the transition to a net zero economy. We, as an industry, we invest capital, lend to, underwrite the real economy. So we're a crucial part of it, but we're also, if you like, the grease, I would say oil, but that's potentially pejorative, the grease that allows the machine of the real economy to keep turning. So our role is very important. I think the capital that's going to be required to fund the transition to net zero is largely going to need to come from private sources, possibly crowded in some cases by public money. The really welcome request that we saw in the Glasgow Climate Pact at COP for countries to come back in the next year and enhance their NDCs and close the gap to where we need to be is fantastic to see, but money will be needed to support enhanced ambition. And for financial services to support the transition, what we really need is clear policy signals and pathways for each sector for how they're going to decarbonise. And that will allow money to flow. And the UK government took a welcome step in respect of that in advance of COP with the strategy they released, which is to be welcomed. But given the scale of the challenge, there is always going to be more to do. I mean, that challenge is that whilst I know we're focusing on the UK economy transition, as a globe, as a planet, we need in the next 98 months to cut 45% from global emissions to give us a 50-50 chance of staying within the planetary boundary represented by 1.5 degrees of warming. The thing is, that change isn't going to be a linear change. Systems change, systems transformations typically take place exponentially, and the role of financial services in helping that transition to be a smooth one is going to be really important to make sure that we do get to where we need to get to. And really, the sort of crisis level that we need all countries, including the UK, to in essence be on sort of a war footing, or the sort of pandemic scale response that we saw. That war footing really needed to avoid the catastrophic consequences, particularly social consequences of climate change, where people won't be able to live where they do. We'll see mass migration and the security consequences that come with it. In terms of financial services, I think it's really important to emphasize the need for a transition. So the trajectory must be steep, but to manage transition risks, we need to make sure that we understand what the companies that we're lending to, investing in, underwriting are doing. And again, the announcement of mandatory transition plans being brought in that was made by the Chancellor in Glasgow is a hugely welcome step, because it will give us a point with which to interface with companies and understand what they're doing in respect to that transition. And transition is more than just shifting money out of polluting assets and into solutions. We really need to use the influence of financial services to make sure that companies do undertake a transition, and we want to see companies actually embrace the need to play a role in the net zero economy and see what they're doing. And stewardship is a really important part of that. So our role as stewards of capital, and really welcome to see the government's emphasis on that in their greening finance roadmap, the DWP's consultation on stewardship at the moment, the excellent work that ShareAction do in respect of stewardship. We really emphasise our stewardship in terms of our role in encouraging companies to transition. I think to what we've seen in those consultations, it's really important to add the importance of not just stewardship with individual companies, but where we reach the limits of what that stewardship can do in the face of market failures or incentives that mean that management is resistant to change. We also engage with the system itself, with government, with policymakers, to seek those enabling policy conditions I mentioned a moment ago. So I would add the need to that to the kind of current debate on stewardship. And also the money that we're talking about, this private financial service money, is largely made up of individuals' money collected together, their pensions, their savings. And so our responsibility is to deploy that money into markets that have integrity. So looking for integrity in markets, correcting market failure is absolutely important. And so in essence, what I wanted to get across is that we have a crucial role, but a crucial responsibility in playing our role in overseeing and helping to facilitate a smooth and orderly and just transition to net zero. Back to you, Eamonn.
Thank you very much, Thomas. I think that sets us up very nicely for our discussion later and for the question and answer session too. But moving now to our second panelist, I'll turn to Dr. Gerard Lyons. Dr. Lyons is one of the leading economists in the UK, and among other roles is the Chief Economic Strategist at Netwealth and sits on the board of the Grantham Institute at Imperial College. He was also previously the Chief Economic Advisor to Boris Johnson when he was the Mayor of London. So I'd be intrigued as to whether he has any good stories to tell us about the Prime Minister's disposition towards financial services sector, given its obvious importance to the capital. But instead of preempting what he'll say, maybe that's just to hand over to him. So Gerard, the floor's yours.
Well, good morning. Thank you for the invitation to be here. I'm speaking in a personal capacity this morning, although I will probably make reference to some of the organisations I'm involved with in terms of this actual debate. Just as an aside, coming back to your question about the Prime Minister, when it was an invitation, when he left City Hall, I was advising him in his second term. He did say one of his biggest achievements was speaking up for the city and for the financial sector. And I think that's an important thing to bear in mind, given the debate we're talking about this morning. There are three parts really I'd like to focus on. First and foremost, to really highlight how far things have come. And it's been very positive. But the way I would phrase that is that we've started to assess and address the problem. But the second part is then about execution, actually providing solution. And the third part of my comments this morning will be to highlight some of the challenges. But in terms of recognizing how far we've come, I think the two key words here are incentives and narrative. Incentives really matter, not just in everyday life or in business in terms of how they influence people and firms, but particularly in the financial sector, where rules and regulations do guide not just what firms do today, but their direction of travel. And we've seen a significant shift, both globally and in the UK, in this whole area of incentives, regulations, and capital rules for the financial sector linked to the green economy. And it's ongoing. And I think we've already passed the Rubicon in that respect, that we've passed the point of no return, where the green agenda is now embedded. And it's not just linked to CO2, as we saw at COP, it was linked to methane, but also very importantly, and we shouldn't forget, biodiversity. UK, while it's been maybe to the front of many of the other areas has probably been slow on the biodiversity issue, but there was a very important Dasgupta report earlier this year. But in the US, the biodiversity has really already seen significant shifts in some of the different regions in the States. So incentives matter, and so too does the narrative in terms of not only influencing how financial firms react, but also now, as we've seen particularly recently, seeing financial firms wanting to appear to be leading the debate. For instance, at COP Vivid Economics, where I used to be on the advisory board, put together that really quite snazzy explanation of how 130 trillion of financial assets is now aligned behind the green agenda. So incentives and basically the narrative, that's the key thing to really bear in mind. And within the financial sector, it's now focused within that in the last few years on encouraging openness, reporting, so we avoid greenwashing. And we've actually, as I say, seen a big move already. That leads on to the second part, which is actually making this work. There are a whole host of issues here that need to be addressed. One of the key ones that's been identified in recent years is that we're now seeing, I won't say a flood, because probably the wrong word to use, but we're seeing an increased amount of money wanting to be invested by individuals in ESG areas, including sustainability. However, there's been a lack of investable assets in which people need to put or can put their money. So we've now started to see the execution issue about bringing more assets to the board. We've seen a couple of examples of this recently, but let me cite one. Bank of China, I'm on the board of Bank of China in the UK. Bank of China rang the bell at the stock exchange 2 weeks ago because it issued a sustainability bond in London. Good thing is it was issued in London, although the underlying bond itself is going to be available globally. So highlighting the importance that London plays here. But the relevance of this, is that the interest payments linked to the bonds are linked to sustainability criteria. For instance, there are water quality projects, there are transition linked to clean energy, and also separate to Bank of China, but in other parts of that domain, we've seen biodiversity. So the bonds are issued, the interest payments are linked to actual making progress. But what we're now seeing linked to the openness and better use of data, and with AI and data generation process, we're likely to see more of this. Firms are now likely to be able to start to direct their commercial lending criteria linked to green agenda. So it's not only going to be in terms of the repayments, it's actually in the initial phase, do firms fit into ticking the green box, so to speak? Are they making valid advances? And this is an important thing in the UK, because what we've seen in the UK is that the banking sector, and this was identified back in 1930s, has been pretty poor at lending to the SME sector, small, medium-sized sector. But what we've seen in recent years is the banking sector has been very good at not only buying government bonds, but lending to the property sector. And this is where the execution, particularly in the UK, is going to be very important. Over the last 25 years, people don't always appreciate how much has been the advance in the UK in reducing CO2 emissions. It's linked to reduction of fossil fuels, electrical generation, and also production processes. But the two key areas where we need to actually crack are housing, including retrofitting, and transport. But in terms of this, it's also potentially complex, as I'll come to in a moment, for the levelling up agenda, given the difference between the urban versus rural areas. Urban areas tend to be better in terms of meeting green criteria just because of the density and sort of the environmental build there. But what we're seeing in the point is that in terms of the execution, it's very important, because the two areas that the UK needs to see significant advances on is in terms of generation, sort of housing and transport. Now, the point is that there's a big difference between what people say and what they do. One of the other think tanks did some work on this last year, linked to the whole stakeholder capitalism versus shareholder capitalism. There was a big difference between what people said they wanted to see and when it came to spending their money. And one of the things at Netwealth, where I'm involved, the last 2.5 years behind the scenes, we've been running social environmentally responsible portfolios, testing them, because the challenge has been maybe 2 years ago, if we were to launch those portfolios, they were just not efficient. They were not going to be meeting our criteria of low cost, and they were not going to be liquid. But now we've seen such a change, we're likely to launch them next year. So it'd be 3 years after we started to run them, because it's now possible to identify enough assets in which one can invest that meet what people want, which is not only achieving the green agenda, but making it sure that it fits within their overall cost portfolios and it's liquid as well so that they can buy and sell. So we are seeing big advances. And the final point of this is linked to the Grantham Institute and Nick Stern, is about the whole growth agenda. 10 years ago, there was a big divide between people who were in favour of addressing the green agenda, as I was then at Grantham, and the wider population amongst economists who thought that this was going to be anti-growth. We've now seen an acceptance that green and growth go together, that it does therefore require more of the capital being directed towards innovation, and the incentives there really need to reinforce this. So the first part was about we've moved a lot. Second part is yet to be achieved in some respects, the execution. The third part, very briefly, is some of the challenges. Britain's net carbon zero target of 2050 is incredibly ambitious. Most people don't seem to appreciate that. The cost of adjustment is very high. If you rush this too much without the private sector and finance on board, it will require significant subsidies. If you push it too quickly, the costs will be too high. Globally, China is seen as being at the forefront on solar and wind, but even in China, they've delayed fully executing their green agenda into the next 5-year plan, the 15th 5-year plan in a few years' time. We need to sort of bear that in mind. This is a global issue, as we saw at COP. The pace of adjustment, whilst we need to be ambitious, it needs to be gradual, not immediate. Take gigafactories. This year, all countries in Western Europe are having to give subsidies to companies to put gigafactories linked to electric vehicles in their country. Tesla, for instance, richest company, or one of the richest companies in the world, was given a grant by the German government close to €1 billion. That's Elon Musk for you. The point is that the technology linked to these areas that we need to embrace are very much in Asia. In terms of gigafactories and that stuff, it's South Korea, Japan, and China. So we really need to recognize that we need to be moving up the value curve. And particularly in terms of the levelling up agenda, the two areas the UK needs to make advances in on housing and transport, these don't necessarily fit easily with the levelling up agenda overnight. They do over time. So the 3 points are, first, we've moved on a lot. The financial sector is now really embedded in this. Second, it's about executing this linked to a growth agenda, linked to actually being commercially viable and profitability. So it's about liquidity, depth of markets, more assets in which we can invest. And third and finally, despite all those positives, I think in terms of the narrative, we need to bear in mind this is about gradual change, not overnight change, and moving in the right direction. 2050 is an achievable, ambitious, and realisable target. Thank you.
Thank you, Dr. Lyons. An awful lot to pick up on there later. Just quickly before I introduce our next panellist, I'd like to give another quick plug for the question and answers, which we will be having after our short internal discussion. Do please get those in if you want to react to anything which you've heard already or are about to hear. And on that note, I will bring in our third speaker, Catherine Howard, who is the Chief Executive of ShareAction. ShareAction is an organisation which works with investors and policymakers to encourage responsible investment. And I know that tackling climate change is one of their core focuses. So Catherine, over to you.
Thank you so much. Good morning, everyone. I'm going to just start with a point that others have already made, which is simply that we cannot achieve a low carbon transition at the pace required without mobilizing financial services. It is utterly, utterly critical that we have our banking sector on board, supporting companies, lending into companies to enable them to transition at pace, to enable them to innovate, because some of this transition in some of the sectors is really really on the cutting edge of where technology, of the technology sits. So we need the banking sector mobilized, and we crucially need long-term investors. Pension funds are utterly central to this, as of course is the insurance sector. Now, the UK is a dominant player globally in financial services. So because finance is so critical to the transition, the UK is brilliantly positioned to enable and accelerate the low carbon transition. And we've been doing this. I think that our financial services sector is absolutely on the front foot. And one of the reasons for that is that we've had really intelligent policy making and bold policy making from the UK government in this regard. And I actually really want to sort of hold up the Department for Work and Pensions. I think the pensions regulations that we have seen come in over the last few years are not only world leading, but they've actually been leading within the UK government. I think the DWP has put in place regulations which have actually forced the pace in the Treasury and in BEIS and other departments. So well done, DWP. We've got brilliant new pensions regulations, and particularly commend the latest guidance on stewardship. The DWP totally gets that we need to decarbonise the real economy, not just decarbonise portfolios. The easy way to decarbonise portfolios is to divest high carbon stocks. It doesn't make any whit of difference in the real economy. And that's what matters to pension savers who, in good faith, put their money into pension funds every month out of a paycheck, hoping that their fiduciaries are really managing this complex set of risks and ensuring that we do transition the real economy at the pace required. But it's not just DWP. I really want to commend Her Majesty's Treasury's Green Finance Roadmap, which was published just before COP, and also the proposals for mandatory transition plans, which were announced by Rishi Sunak at the COP. These are really powerful initiatives. And obviously, because we hosted the COP for the world, it was a fantastic sort of incentive for us to show what leading public policy looked like. But I'm really proud of what the government's done. So that's the good news. Now, the bad news is that I think we need to be yet bolder. We actually need to go further, because the scale of transformation and transition required is kind of unparalleled. I mean, people talk about putting our economies on a war footing in order to transition. And I think that the key tools that so far we've been looking at are around disclosure. Disclosure is critical because it absolutely enables the market to kind of get the right signals and so on. But I just think we probably do need to go even further. And let me give a kind of practical example. Pension funds. I think pension funds interpret their obligation to act in the best interest of beneficiaries in relation to optimizing portfolio returns rather than thinking about that real economy impact. So when you think about trustees considering green tech investments or looking at what's happened this year in terms of coal prices skyrocketing and fossil fuel prices skyrocketing, there's a lot of these sort of short-term signals and incentives, which if you just focus on portfolio returns, I think leaves trustees still in a bit of a quandary. So what I'd like to suggest is that the next generation of reforms, the next layer of innovation and policy leadership relating to financial services would actually free up trustees to meet public expectations by targeting their portfolios and their investments to achieve real economy outcomes and not just to optimize portfolio returns. Because I used to be a trustee of one of the UK's largest pension schemes. Trustees are very kind of cautious about butting up against the legal advice that their advisors provide them with. And at the moment, the legal advice is still to kind of really focus on optimizing portfolio returns rather than thinking about the real economy outcomes that would enable the long-term best interests of pension savers. So I just want to leave everyone with that thought that I think there is a next generation of fiduciary duty reform needed to build on what's been done so far that would ensure that we give trustees the freedom to act in the best interest in an even bolder way and really focus on investing in green and stewarding in a really tough way the high carbon companies so that they make that transition, even though in the short term that could be quite challenging from a financial point of view. It's about focusing on the really long term, thinking what are the outcomes that we want for savers, not getting distracted and feeling inhibited by the short term price signals in markets, which this year in high carbon and fossil fuel have been, going in the wrong direction. So I just think there's a next generation of reform required, and I hope that CPS, which has got an amazing tradition of supporting bold policy thinking that frees market players up to do what they need to do, that we can have that debate and think about what comes next.
Wonderful, thank you for that, Catherine. All very interesting again. Now, last but not least, I'm going to turn to Guy Opperman, who has been the MP for Hexham since winning the seat in 2010, and importantly for today's discussion has been the Parliamentary Under-Secretary of State for Pensions and Financial Inclusion since June 2017. So, Minister, would you like to give us your remarks?
So, thanks to the CPS, Eamonn and Robert Colville for inviting me, and all sponsors and supporters who've made this happen. I think it's good that I'm going last because I can endorse much of what has been said already. I genuinely believe we are on a journey, and that journey as a country sees us travel from first G7 country to have a net zero by 2050 plan, very much the pioneer, in my view, of ESG, and someone who's embraced ESG in a way that other countries now look at us with envy. And obviously the first country in the world to introduce TCFD, which is utterly game-changing in this space. So I think that journey, and obviously hosting COP at this crucial time, was clearly vital and very key. I thank Catherine for her endorsement of the journey that we're on and the work that we're doing. But I kind of want to discuss a couple of key points, which is I also see this as an opportunity for the financial services sector, because it seems to me that we're effectively first in market. One of the upsides, and there weren't many, of Trump being in the White House is that you had a situation where a very key competitor of the UK City of London was not engaged with climate change, was not engaged in any way with coming up with solutions, and was not engaged with actual products and stewardship and voting and actions that then articulate and engage the journey to net zero. So I think the UK has an opportunity in a post-Brexit, post-pandemic world to lead the way on this. And that is something I think we should embrace. The question, therefore, is how? And I think that you can look at some of the things that we have done. And my takeaway on COP was, in fact, that lots of people were looking at the UK and saying, OK, so you guys have done TCFD. We like the look of that. You were the first country to actually put it into law. The regulations came in October. This is very significant. We will take that away. They look at, as Rishi's decision to do mandatory net zero transition plans. That is something, in my view, that is very seismic. Now, the how going forward surely has got to be as follows. The first is stewardship. It seems to me this is utterly, utterly key. And engaging in the companies you invest, both now and in the future, is going to be the game changer, in my view. And I totally endorse the argument that action and then voting is the way ahead, not divestment. Divestment is a fool's gold. It is a completely insane idea to do. It will get none of the outcomes that everybody wants to try and achieve. Now, I very much believe also we have to embrace the problem. So, we are not going to get to net zero without nuclear energy, for example. So those who want to argue on this call or on other calls that nuclear energy is not green and not the way ahead, leave now, as far as I'm concerned. It is absolutely part of the future, and we need to embrace this. And I massively support the work that Kwasi is doing at business. I've got limited time because I know that people want to come in on questions, but I would make one key finish, which is slightly going to the point that Catherine was making at the end. So I can talk about, the work we've done on TCFD, ESG, on stewardship, on voting, on Paris alignment and the consultation that's presently out there. But I think it's more about the issue of value. So traditionally, a pension investment has been assessed on the basis of returns and costs and charges. All right. And I genuinely believe there is a sea change, certainly something I'm trying to drive forward, of an understanding of what the value of the investment is and what that wider value is in the short, medium, and longer term. And the utter importance of trying to get a debate upon that is, I think, really important. It is exceptionally hard for government then to step in and say, we can define and we know what value looks like. Although the FCA and the TPR and myself, we are all trying to look at this in this particular space. But I have to say, it's obviously about, costs and charges are an element. It is obviously about the investment performance. That is an element. And scheme oversight, that is an element. But it's also about what is the nature of the investment and what is the benefit that is receiving, not only to the individual scheme member, to the wider society as a whole. That's a hard one to figure, but it's certainly a challenge that we embrace. So for my part, I think we're on a journey. We are heading in the right direction. And from a point of view of financial services, this is both this is fundamentally an opportunity that should be embraced, because the UK has a great future embracing this problem and solving this problem.
Wonderful, thank you for that, Minister, and indeed to all of my panelists who've given our remarks. So for the next sort of short part of our time on this webinar, I think we'll blend some questions that we've had from the audience, some of my own as chair's privilege, to really pick up on some of the things we've just said. And I think one of the things which has stand out in all the remarks we've heard so far is obviously sort of the changes and announcements we heard at COP26 and what they might entail for the financial services sector. Guy, I don't know if it's a bit unfair of me to pivot straight back to you, but perhaps you could kind of weigh in quickly on what we heard, maybe some of what we heard from Rishi Sunak about some of the things he was saying during COP26 on the Finance Day quite early on in the conference. And how do you think those will kind of change how investments and the financial services sector kind of deals with investments in sort of the economy and incentivizing green investments too?
So we work with Treasury hand in glove. There's no question whatsoever. I mean, I'm in charge of all of the well over £1 trillion private sector pensions, but the reality is Treasury have a lot of the levers as well. And I think you can look at the key thing is, how do you regulate? So first of all, what regulations is the Chancellor and DWP bringing in to frame this debate? The second is, how do you nudge and push forward the direction of travel? I think we're doing that. TCFD is, climate-related financial disclosure is an obvious way in which you can quite clearly then show that particular way forward. The third is, I think those countries and those companies who haven't got net zero plans are going to struggle to access capital in so many different ways. And this is like a 30 to 40-minute discussion, but the simple point is they're going to struggle to access capital. And that is a good thing, because it is a nudge to better behavior. And the final point is, government needs to try and showcase the way in which they are going to do certain things. Now, you can have a look at various things, whether it is the 10-point plan by the PM as to setting out how you're going to do the energy transition, or whether you look at the green gilt. We've issued one. It was oversubscribed about 10 times, which shows the appetite there. You can look at what's called the long-term asset fund set up by Treasury and Bank of England. Those are opportunities to invest on a long-term basis that genuinely will make a difference. So that's kind of where I see it.
Brilliant, yeah, and kind of on that note, the sort of talk about nudging, talk about incentivizing, I think it's something which Dr. Lyons said at the start of his remarks, Thomas as well, I think you touched on it, and I'm sure Catherine too. Thomas, maybe you could weigh in and say, we've had some signals, some quite big signals, not least in the form of the net zero commitment itself. Are there any other signals which you'd kind of like government to sort of be coming out with to help you kind of know exactly what to do in your business day to day?
So the fact is that markets react to the signals that we get from government, as I mentioned. So setting out clear decarbonisation pathways for every sector is crucial. That will help us work out as investors where we should be putting our customers' capital. I mean, one thing in terms of the decarbonisation that's really important is working out how we internalise the externalities of pollution, how we make embrace that kind of pollute to pay concept. One of the key ways is pricing carbon. So showing us that there will be a significant and rising price on carbon, giving that kind of forward guidance allows us to assess which companies transition their business models and decarbonize, and which actually are going to be hit by that and become less profitable and therefore less attractive as a result. So, and markets don't wait for those policies to actually hit. When you've got clarity and belief that they will be implemented, markets move ahead of those. So getting those clear one-way signals, particularly price and carbon, will be the one that I would call out in particular, help us to assess which assets are best positioned to benefit from the transition and which actually have higher transition risk.
Excellent. Well, we're big fans of carbon pricing here at the CPS, so we fully endorse that as well. Catherine, I don't know if you, sort of similar question itself in kind of signals or anything, which you're kind of, if you could wave a magic wand to get Guy and his colleagues in government to do, what would that be?
Well, I really liked what Guy was saying about value. So what is valuable to pension savers? Obviously, it's securing excellent financial returns, but we're now in a world where what's valuable goes beyond that. What pension funds, and when you survey and ask pension savers, they're incredibly interested in having their retirement assets invested in companies that are, helping to decarbonize, minimizing biodiversity loss and species loss, not invested in companies that are using slave labor in the supply chain. It goes beyond the E and into the S of ESG. So these are things that pension savers value, but I think our sort of rules of the game in pension investing have opened up in a very, very positive way. But I still think we're not able to kind of calibrate risk, return and impact in the structure for fiduciary obligation that we have. It's not a silver bullet fixing that. I totally, completely endorse what Thomas was saying about carbon pricing. I think we really won't get out of this fix without carbon pricing, but carbon pricing is one factor. And actually, when you think about biodiversity, which Gerard raised in his remarks, we actually do need an environment for fiduciary decision making that allows us to capture that bigger understanding of value. I think that's brilliantly put by Guy, that actually trustees, I think, are currently inhibited. And in order to meet the challenges of the future, we need to free them up to think about value in that bigger way. And that would, I think, really give a mandate for investing in a way that actually truly does meet the needs of pension savers in the 21st century.
Thank you, Catherine. Gerard, you've been sitting patiently, so I'm going to turn to something you picked up on, and indeed the other panelists as well. We're obviously now in the post-Brexit world, and there's been a lot written about what that means for the financial services sector. Different accounts by different newspapers, perhaps. Are there any policy areas where you could point to where you think leaving the European Union will genuinely help the UK financial sector in terms of being able to do more for the environment?
Well, yes, but I want to come back on the previous question, if I may. But on this particular question, the key issue in the UK is actually about achieving stronger economic growth and tying in terms of this debate with the sustainability agenda. The UK's economy has completely underperformed, both immediately prior to joining the EU, but since joining the EU. What we now actually have post-EU is the ability to set taxes and regulations in the way that better suit the domestic economy. In terms of coming to your question, there are three aspects. One, the good relationship with the EU in a whole host of areas. Second, the ability to set our domestic agenda more particularly for the UK economy. And third, in terms of positioning ourselves with the rest of the world. When it comes to the climate agenda, we're cooperating with the EU. But when it comes to actually specific policies, yes, we can actually do more both on the regulation front. And even though the tax side was there when we were in the EU, I think it's reinforced by that regulatory freedom. So it's stuff that you've written about at the CPS and others have written about. But if I could come back to the previous point that the Minister has made, was also just made about fiduciary responsibility and value. Look, I think there's a dangerous path to start going down if we think the solution to this is to change the fiduciary responsibility of pension trustees and others. What I would argue is that one can have a socially responsible portfolio and socially responsible pension fund within the existing fiduciary responsibilities. I think it's dangerous ground to start talking about concepts that cannot be fully quantified, as important as they are, such value. Naturally, if people decide they don't want to put money in fossil fuels, good. If they don't want to invest in armament companies, good luck to them. But the point is that the existing framework in terms of fiduciary responsibility, I would actually argue, sits well with the actual agenda that we're talking about. The incentives, the rules are important, as we've all touched on, and also the behaviors in terms of where people spend their money and the commercial viability. That doesn't argue for fiduciary responsibility to change, in my view, and it's a dangerous ground to go down, and it starts to get us, I think, off the straight and narrow in terms of where we are going, which has been a successful story to date. Hopefully the regulatory side and that fiduciary side answer your points.
Can I come back on that? Can I come back on that? I think it's helpful if I try and clarify. So I have resisted changes of fiduciary responsibility during the passage of the Pension Schemes Act in Parliament in the winter of 2020-2021, and very robustly pushed back on it. And it's not the intention to in any way change fiduciary responsibility. I don't think that is the way ahead. It is, though, particularly in the world of automatic enrolment, it has become the situation that a investment is seen through a very narrow prism of performance returns to a certain degree, but particularly costs and charges. And it is trying to widen that debate about the nature of investment and the outcome from that investment. Now, I wanted to stress that this is not something that, this is something that the pension regulator is looking at. This is something that the FCA are looking at to see if there is something that one can do in this space. And I think there is I always say with pensions is savings for the longer term. And of course, if we don't crack climate change and get to net zero, there isn't going to be much of a very idyllic longer term. And so the two, in my view, have to work together to the best of their ability within the laws and the rules that apply. And I think the way you do it, and I've seen some of the questions in the chat as to whether regulation is a good idea and the extent to which nuclear is green and things like that. The way you do it, in my view, is you do it as recommended by the Law Commission and others, and you have ESG, and you make investments take due account of climate change, as ESG investment is effectively doing. I'm summarizing, but that's the effective reality of it. Then right. Secondly, you have proper disclosure. Again, TCFD is something worldwide organizations have said is the right way forward. So you have climate-related financial disclosure. So I know how it is the investment is done. I know there is the disclosure of that investment, and then you can then take it from there. There is an argument, I have a very strong view on it, that nuclear includes green. It hasn't been included in the green and gilt. Maybe I can make the case that will change. But in reality, we then try and direct and encourage investment in those particular ways. And I think at the moment, certainly in the pension space, there's no league tables. So I can't really, and this is something that, in my view, the likes of CPS or ShareAction should pioneer. If I go and have go to a hospital and I have my leg fixed, I can measure the outcomes of that hospital. If I take my child to a school, I can measure the outcomes of that school. I can't measure the outcomes in reality of pension schemes in any meaningful way. I certainly can't measure them as to how it is asset managers and pension schemes are on their journey to net zero. That, in my view, is a really great piece of work that can come out of discussions like this, because having a real understanding of and there'll be various ways you do this. I'm not saying there is one prescriptive way, but having a real understanding of how my money is invested, or how the UK PLC's money is invested, and what is the outcomes from those investments, both in terms of simple returns, and as Gerard makes the point, you can invest in XYZ organizations to get better returns, or in returns that are green in inverted commas. That is something worth measuring, in my view. Very difficult to do, not easy, I accept, but looking to do that, encouraging and nudging people to do that will, in my view, then translate into outcomes. And outcomes is what we're all about.
Thank you. Hopefully that ticks off some of the questions we've already had in, as you say as well. One question which we got in advance of this discussion, and perhaps I can pitch this to Thomas, is that it seems that sort of the shift to net zero and taking action on climate change kind of changes a lot of maybe the model of investment. You know, a lot of the things we need to be doing are very capital intensive. They have high upfront costs and then possibly smaller costs ongoing after that, just thinking about electric vehicles or certain forms of electricity generation. As somebody who's kind of working this day to day, has that sort of had to change your thinking around these things? You know, maybe taking an even longer term view on some of the investments that you're kind of looking over.
So anyone who works in any sort of regulated financial services is very familiar with having to put on every financial promotion that we put out, saying the past performance is no guide to the future. That, as a phrase, has never been more true, in my opinion, than it is today. But not just in respect of looking at your fact sheet or whatever it might be of your product. Actually, in terms of the whole economy, the intention, the ongoing intention stated by governments around the world at COP, that they're going to aim to deliver this 50-50 shot at 1.5 degrees, which means cutting 45% against 2010 levels from emissions in the next 8 years, is going to see incredibly dramatic changes in our economy and the way that we have to think about investing. So yes, thinking longer term is a very important part of that. And given that we've been talking so much about pensions, that idea of balancing the short and the long term. So Catherine was talking about, you know, the short term opportunities that are made that actually probably are harming long term, both returns financially, but also long term sustainability considerations, and taking those long-term investments and thinking, actually, I have to balance. So our duty, and we've been talking a lot about fiduciary duty, our duty includes the need not to prefer the needs of people with short-term aspirations over the need of people with long-term. You have to take both into account. And that's within the existing framework. So I think the need for more forward-looking rather than backward-looking financial analysis is becoming clear. And Guy's talked a lot about TCFD, and one of the really welcome elements of TCFD is its focus on scenario analysis and forward-looking assessment of risks and opportunities. Another is the fact that we have to recognize that this is about opportunities as well as risks. So identifying the opportunities, thinking about that seismic change we're going to see in the next 8 years and which companies are well positioned to benefit from it, is a different mindset than perhaps has worked over sort of previous economic cycles. So in short, yes, there is going to be a need for a very different mindset, but it will still be grounded in understanding fundamentals and making sure that the fundamentals of an investment add up and will return over the long term.
Excellent. Thanks for that, Thomas. We've had a question in about greenwashing, and perhaps Catherine, I can turn to you first. And Gerard, I know you also mentioned that in your opening remarks. Do you think, Catherine, that greenwashing is a significant problem? Is it something which you think is becoming less apparent or more apparent, or what are your thoughts around that, particularly when it comes to sort of investments that people are kind of pledging with regards to climate or indeed even wider environmental purposes?
Yes, I do think greenwashing is a big challenge. The reason greenwashing takes place is that retail investors, ordinary people putting money into capital markets to be invested by professionals, actually have a huge appetite for sustainable investing. And the markets recognize this. And so there's a massive number of new green products, ESG. It's boom time in ESG. And whilst I hugely welcome that, because as I said at the very beginning, we won't solve the sustainability and climate crisis without mobilizing financial services, there is a risk and a real problem out there, which is that things are being labeled green when, they've basically just slapped a green label on an old product. Now, pleased to say that the Financial Conduct Authority is totally stepping up to the plate on this. It's just launched a new disclosure and labelling working group, which will do some really good work on this. It's very important that we do have market integrity insofar as people can see what they're really investing in. And it's also fair on firms like Aviva that are really going the extra mile and doing the real thing, that they shouldn't have to compete with other funds that are just, doing a less serious job of being green. So yeah, I do think greenwashing is a challenge. I think it emerges because of genuine, real demand in the consumer sector for green products, green investment products. And I very much hope that and expect that we'll get regulation and supervision of firms that creates real transparency and higher standards. So I think that's positive. If I could just come back to Gerard's challenge on fiduciary duty really quickly, because he was saying, let's not mess with it. And I kind of want to reaffirm that we mustn't mess with it. Like the fundamental of fiduciary duty is that an investor that acts on behalf of another person should always act in their best interests. And I think that that's the fundamental root which we must hold on to. Now, I think that currently trustees interpret that as we've got to chase short-term returns and we've got to focus on charges. And actually, they should be liberated to think about the real underlying value over the long term of these investments, given the scale of transition underway. So I completely agree with Gerard's challenge, but actually I do think that trustees in practice feel quite inhibited by the legal advice they get and the focus on short term and charges. And we actually need a bigger picture and a more holistic approach. And I really like the government, the minister's sort of thinking on values and outcomes. That's what matters for savers.
Okay, Gerard, I don't know if you want to come back either on the challenge to your challenge, as it were, or the point about greenwashing.
Well, the challenge to the challenge is that people should actually move their funds to actually where they're managed properly and actually invested properly. You shouldn't change the overall structure just because of some poor performers. They should be the ones who actually are not rewarded within the way in which people actually allocate their money. But coming back to the greenwashing, this is very much something in terms of Netwealth, where, as I said, we're about to roll out our socially responsible portfolios. When we started these 2.5 years ago, it was quite evident it was difficult to differentiate fully. But now it's quite clear that greenwashing, I won't say it's being fully addressed, but what we've now seen is significant advances so that one is actually able to recognize a whole host of good investments that are out there. But it comes back to the broader point about this greenwashing. In the financial industry, over time, well before sustainability, there has always been the issue that there will be funds that move to outside the regulated environment. Take even banking. We've seen the growth of the shadow banking industry. So the nature, therefore, has always been to shine more light on those areas that are in the shadows. So in terms of the green agenda, and the minister touched on this and others have touched on this, openness and transparency is key. That's the essence of it, but also improving and or increasing the amount of investable assets into which you can actually put your money, whether in the UK or globally. And those two developments are now moving forward leaps and bounds. But the other point is actually to make sure that the poor performers are not only sort of not rewarded, but in terms of this area, that when the light is shone, that there is a regulatory response to penalise those, or to make sure that those who actually go into that greenwashing area have suffered the consequences. So I think we are seeing big advances in this, but more will naturally have to be done.
Excellent, thank you. We are quickly running out of time, but I'm quite keen to give Guy the opportunity just to say any final closing things, maybe anything you've heard today that sort of piqued your interest in particular.
Okay, no pressure there. So I think the development of the discussion about measurement of investment on a long-term basis, I think, is key. And I think all governments would welcome assistance and understanding of that. Sunlight is the best disinfectant. So have full disclosure, in my view, makes a massive difference. But then also try to articulate where it is that that investment is going. And I think, I like the symmetry, because with pension funds, you invest for 30 to 40 years. And with net zero, this country is on a 30 to 40 year journey. Now, Some would like us to go faster, other countries are going slower, but by and large, everybody has signed up to 2050. And it is trying to marry those two up in terms of actions and in terms of taking those communities with you. I mean, I accept entirely, as the man who represents the most rural constituency and the largest constituency in England, I fully accept that there are issues on rural housing and rural transport that are massive. And as a man who's got a gigafactory set up by and visited by the Prime Minister barely months ago in Northumberland, we are trying to make real less efforts on those. I think the message surely should be, though, that if ever there was any doubt that an asset manager and a pension scheme trustees were not important, that doubt has gone. They are the most important people in terms of the direction and the pathway that we get to net zero, because the direction of capital and the stewardship of capital and then the voting that follows is utterly key.
Brilliant, thank you, Minister. Now, we are sadly nearing the end of our time here today. And as I said previously, this is the final instalment in our Getting to Net Zero series. So I'm going to hand over briefly to Frank Carson of Aviva, who, as I mentioned, have been partnering with us throughout this event series, and it wouldn't have been possible without the support. So Frank, if you'd like to come in and say a few quick words.
Thanks, Eamonn, and thanks to everyone else who's participated in today. So I'm really pleased that Aviva has been able to sponsor this series. Aviva has been working for years on tackling climate change, and we've got our own net zero plans by 2040 covering everything we do and everything we invest in. And I think the more we do in this space, the more we see the need for effective partnership between businesses, investors and government, which is exactly what this series has helped to develop. So we've had a great mix of speakers, really impressive, productive debates. And just a reminder, I mean, the series kicked off at the Conservative conference, where we focused on the scale of the challenge and how to maintain the right kind of support as lifestyle changes begin to bite. Then we had an event focused on the key role transport can play in driving down emissions and the sorts of policies needed to get there, like road pricing. Then we had an event looking at energy and the sort of energy mix that's required to achieve net zero, and how business and investors and government can work together to get that shift. Then at the event on buildings, we had the chair of the Climate Change Committee, Lord Debon, challenging the industry to go further and faster on decarbonising the building stock. But an important lesson about focusing on commercial buildings, not just housing. And then today's event on finance, which I think has been a great debate, particularly wants to sort of flag up what Guy was rightly saying on the critical role of stewardship role of the pensions industry in driving net zero. I just wanted to say that Guy has been a real trailblazer on this and deserves huge credit. It's good to see recognition of the government's groundbreaking work more widely. So with mandatory net zero plans and the ambition for the UK to become the world's first net zero financial centre, which is all good stuff. Next year, I think, will be a huge year for net zero policy. So just a reminder, to keep warming within 1.5 degrees, global emissions need to be cut by 45% in just 98 months. So that's a monumental challenge, but it is achievable. And I think this series has been a really important part of building the ideas and the collaboration that will be needed to deliver. So a big thanks to everyone that's participated in the series. A big thanks to Guy, and a big thanks to all the team at CPS for organising it. Eamonn, over to you.
Thank you, great stuff. Cheers, Frank. So yes, that does unfortunately bring us to the end of today's proceedings, and I think very nicely rounds off this event series. If you want to check out any of the previous panels in the series, you can do that via the Centre for Policy Studies YouTube page. I'll also encourage you to go to the CPS website to sign up for our newsletter, so we can bombard you with invitations to more excellent events like this, I hope. You can also follow the CPS on Twitter if you don't already, at CPS Think Tank. You can follow me at Eamonn Ives, where you can keep up to date with all our musings on environmental policy and beyond. Again, I'd like to say a huge thank you to my panelists today. I think we've had an excellent debate, and indeed to you all for watching at home or wherever you might be. So yes, I hope you've enjoyed the discussion, and I wish you all for the rest of the day. Thank you.